Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Courser. Ron Courser and Associates are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids CFP Certified Financial Planner, President and Founder of Ron Courser and Associates. Ron Courser is here with us. Ron, welcome back in.
Good morning, and good morning to everybody listening to us either on the way to church or sitting hunkered down in your home trying to avoid all the stuff going on around us. Good morning to everybody. We're going to have an interesting show today. Why would I use that word? Well, we're right in the middle of tax preparation season, and that's foremost on everybody's mind. And most people, what we do, and I've certainly done it when I was younger, you just wait till the end of the year, collect all your data, the 1099s and everything like that, put them in a brown paper bag, go to the tax guy and say, here, make it go, fix it, do something. And all of that really is just taking care of what happened last year. We can't make any more changes for last year, but what we can do is start to think about this coming year, given the fact that taxes are kind of foremost on everybody's mind right about now. So what we're going to talk about is an article that came out of a magazine, Your Money, the 6 stealth taxes that can derail your retirement. And we'll talk about some other kinds of places where you can put money, which may have some advantages from a tax perspective for you. I think it's an important thing to talk about because what I always encourage people to do is be somewhat more proactive. What do I mean by that? Well, we can't change the tax world that happened last year. That's a done deal. Now we just got to figure out if we have to pay more money or we're going to get money back. But what we can do is figure out what we're going to do this coming year in 2021, 2022, 2023, 2024. Whether you're 35 years old and you have a lot of time to retirement, or you're 65 years old and you've retired and you assume God's going to let you live for more than 15 weeks. Planning and doing some work on taxes on a proactive basis makes great sense for everybody. So what we're going to do is we're talking about the 6 of them, and then we're going to focus on some other options. Now, if anybody out there, once you hear what we're talking about, if you have an interest or you want to talk to us or you have a question, please give us a call at 616-301-2581. That's 616-301-2581, or go to our website, www.roncourser.com, and put your question in there, and we will get back to you just as fast as our little feet will carry us, and we'll give you the best kind of information you can get. So stay tuned to today's program. I think it'll be a good one, talking about something nobody likes to talk about except CPAs, and I'm very grateful for them in my life. I have a great CPA. He does things, and what do I want to encourage people? Okay, we're going to talk about some specifics, but let's also in the back of our mind think, how am I going to use this information? So what I want to encourage everybody, just right now, off the kind of the front part of your forehead, is give some thought to using your tax preparer in a more aggressive way. You might, I hate that word, but I might use it. Of saying after tax season, after you get your tax return and you see, what allegedly the damage has been done, is come up. We can help you come up with some ideas that you can take to that tax person, pay them a little bit more. They'll love you for paying them, but they can do the work that says, look, I'm going to make some changes in how I'm dealing with my money, with my income, with my investments to have a tax advantage for me. And you can put them to work. That's what they're good at. All CPAs focus on one thing. Let's reduce taxes. But sometimes, and we're in that environment, in my opinion right now, sometimes planning for future tax increases is also an important thing to deal with. And how are we going to minimize the impact of potentially higher tax rates and higher real taxes in coming future?
Well, Ron, I think that a lot of times CPAs deal with the obvious taxes, the income tax, the ones that everybody is immediately concerned about, and sometimes not so much those stealth taxes as you just referred to, things that can cost us significant money, but maybe are not as top and front of mind as what we are going to pay on this dollar right now between the time that I earn it and I actually get to spend it. And that is what most Americans, I think, are worried about this time of year, is how do I keep keep as much of my money from last year? And I know that there will be a lot of busy work going on for the next couple months on how to keep as much of our money from last year. But keeping as much of our money from last year can actually result in us encountering a few of these stealth taxes that can be more costly. And that's why I think you promote that it's a good idea to spend some time with that CPA and really talk these things through, because immediate pleasure could be long-term pain, or vice versa. We could handle a few of these things in advance so that they are less painful into our future. And I know that the conversation, Ron, can start with you there in your office, because you do help people with identifying where these stealth taxes may be an issue, and then coordinate with the CPA or the accountant in order to plan for them. And that process, ladies and gentlemen, starts with you picking up the phone and giving a call, 616-301-2581, 616-301-2581. But Ron, would you say that that is the case, that a lot of times people are more preoccupied with those obvious present day taxes rather than these stealth ones?
They are. It's pretty normal. It really is. There's nothing abnormal about it. We always are focused on what's in front of us. But one of the things that we do, we're not CPAs. We don't do taxes for people, but we're smart enough to help them analyze a tax return and to give them some questions to think about, and also questions that they can take to their tax preparer and say, what about this? What about that? How about if we try this? What would be the impact of that? And I tell people, use the tax guy. You know, you pay them a few extra dollars, they love it, but they can be a great resource for you. So let's go through these 6 stealth taxes that can derail your retirement. That's really the focus we're going to talk about. And then later on, we'll talk about some different kinds of accounts, which also may have some tax advantages for certain people out there.
Yeah, let's go through them, Ron. What are some of the top of mind ones for you when you say stealth taxes? What are you thinking of there that people might not be fully aware of but could be costly for us?
Well, here's a big one. This is a new kid on the block, so to speak. It's the new 10-year payout rule that applies to inherited IRAs, and it came from the Secure Act and was effective after the 31st of December 2019. Here's what it does. Prior to this rule, if you inherited an IRA, it didn't matter who, the spouse, children, grandchildren, you could stretch the payments, the required minimum distribution payments on that IRA for your life expectancy. So for example, I have my youngest grandchild right now is 6 years old. She's got a life expectancy of about 148, I think. So if we ever left her some money, depending on how we do it, she could have stretched it out for their whole life expectancy. But here's what has changed now. We have what's called the 10-year payout rule. What that simply means is, with the exception of spouses, children under the age of majority, and some children that perhaps have disabilities and things like that, you can no longer stretch an inherited IRA your life expectancy. What they've done is they said, look, if you inherit an IRA this year and you're not one of those 3 or 4 categories, you have to liquidate that IRA, meaning take all the money out between tomorrow morning and 10 years from now. After 10 years, if you've left money in there, we're going to tax and penalize you. But there's not going to be a required minimum distribution. So why would this be a problem? Well, let's say you inherit an IRA, and if you take all of the money out, you can liquidate it now, even if you're under 59 and a half. There's no 10% penalty on inherited money. That just gives you more taxable income. So what it does ultimately, particularly with folks who've been blessed with larger IRAs and they have other income and they don't necessarily need to liquidate these things, it could potentially force you in through either a higher tax bracket, or certainly by taking too much out of this within a 10-year period, you're going to pay more tax on it, which means it's going to be less valuable. So understand this, it doesn't apply, this 10-year payout rule does not apply to spouses who inherit it, children who are under the age of majority, or other non-eligible designated beneficiaries. But it's a rule that really creeps up on people, because we've had clients who've inherited money prior to January 1 or December 31st, 2019. They can still take their whole life expectancy to liquidate that IRA. Anybody whose parents or whoever left the money died after the January 1st of 2020, you're subject to this 10-year rule. It requires a little bit of planning if you've inherited that IRA. You have to know where your taxes are, where you're potentially going to be. This is why it's so important down the road after tax season, don't do it now, to involve a tax professional to help you. We can help you with the questions. We can help you with the what ifs, so to speak, that you can then take to your tax provider and say, what about this? What about that? So the first stealth tax is this change in the payout rules for inherited IRAs. If it's a small IRA, generally it's not going to be a big deal. But for anything that's sizable, it can be a very big deal in terms of how much tax is taken out of that. And for every dollar of tax that you pay that you don't have to, it's kind of like a dollar wasted, isn't it? So let us help you with it. Let us work in connection with your tax advisor. Give us a call at 616-301-2581. That's 616-301-2581, or go to our website, www.roncourser.com. Be more than happy to help you with that.
And this can impact us in a couple ways, Ron, because those RMDs that we are now required to take during our own lifetime are now going to be higher because they are packed in over a shorter life expectancy. And then when the assets do pass on to our next generation, they will be required to be liquidated and thus probably taxed at a higher rate. So, Ron, how are you helping people through this and maybe planning for this stealth tax and identifying where it might affect them and how to make the most of each and every dollar they've worked so hard for?
That's a great question. And one of the things we try to do is when a client of ours inherits money, what we immediately do is we sit and chat with them about what they want to have happen with that money. And then we create a new, so to speak, income plan for them. Now, if you're still working out there, you say, well, I don't need an income plan. I already have income. You're absolutely right. But guess what? You just inherited an IRA. And whether you like it or not, at some point in time, you have to start taking money out of that IRA, and it becomes a taxable event. It becomes taxable income. So one of the things we do to help is to say, wherever you are, if you're working, let's take a look at last year's tax return and see where you are, both in the brackets and what your real tax rate is. And then just make a decision or create a strategy. How do we liquidate? How do we take the money out of this inherited IRA between today and 10 years from now that'll make the most tax sense to us, that'll help us pay the least amount of tax on what we've inherited from our mom and dad or an uncle and get the most for it? So part of the process is really simply sitting down and doing an income plan for somebody that's not retired, but who's still working. They still have income, and they need an income plan, particularly when they have this other thing that's just been layered on top of them. So that's one of the great ways we can be help to people. So if you'd like that kind of help and consultation, give us a call, 616-301-2581. We'd be more than happy to help you. We're good at trying to help people. That's what we try to do all day long. So give us a call.
That is the mission there at Ron Courser and Associates, to help you. Ladies and gentlemen, if you are serious about your planning, about your financial future, about keeping as much of your money as possible, certainly you don't want to be hit by any of these stealth taxes that we are discussing with certified financial planner Ron Courser today. So give them a call, 616-301-2581, 616-301-2581. Ron, this is another one that people are pretty commonly affected by. And a lot of times we don't receive any education until it sort of smacks us in the face, but the stealth tax on Social Security.
That's a big one. It's a big one. And it's one that a lot of us have trouble making some sense of, but I won't go into that one today. That's a subject for another time. But it is possible to have a good portion of your Social Security benefit included in taxable income. And it's a bit convoluted. There's some threshold adjusted gross income, non-taxable kind of interest places. But for example, single individuals, how do they figure out if they're going to tax a portion of your Social Security? Well, here's a back of the envelope way to think about it. Take half of your Social Security benefit. If you're single, take half of it. If you're married, take half of the combined one if you're both getting Social Security. And then add everything else in. IRA deductions, any part-time work, CD interest, that's going to be a biggie for a lot of people, right? Because they're paying a lot of interest now, these CDs. Any kind of income that goes above the line, so to speak, of AGI. It's taxable income. So you take 1/2 of your benefit, add everything else in. Now, here's how this comes into play. So with a single person, there's thresholds. If you take half your Social Security benefit, add everything else in, and that number is under $25,000, as a single person, you will pay 0 tax on your Social Security benefit. That's significant. It really is. If, however, you have a little more, between $25,000 and $34,000, half of that in that range is included in taxable income. It's not taxed at 50%, but half of it can be included in taxable income. If that number, 1/2 of your Social Security benefit plus everything else, is above $34,000, up to 85% of your Social Security benefit can be included in and will be included in taxable income. It's convoluted. That's the way the rules are. I get a question a lot of times. People say, wait a minute, I paid tax. I put money in there. That came out of my paycheck, and now I got to pay tax on it again? And my response is, yep, that's what the rules are. I don't have any control over that, but next time you go vote and a politician comes into town, ask him about that.
Yeah.
see what he has to say about it, or what she has to say about it.
Well, technically, it was not taxed. It was just held for us out of love and care, out of our paycheck, so that we would not splurge and spend it all. Right? It wasn't necessarily taxed when they withheld it, Ron. It was just put away safely for us to use at a later time, technically. So when they give it back, it may be taxable, I guess, is the thinking.
Well, it kind of reminds me of when I was a young kid and my grandfather would give me a nickel. And he would hide it, so I used to have to find it. And then I would find it, I would spend it. But it's one of those things that's like, wait a minute, I'm a grown human being. I'm reasonably capable of handling my money. You can take it from me, and you're already taking after-tax dollars. Why are you doing it again? The response is, I'm from the government, and I'm here to help you. So enjoy.
Always be wary. Always be wary of that one.
Those are the worst words you could ever hear. I'm from the government. I'm here to help you. So we've dealt with the single person. What about the couple? They have income limits also. So a couple, again, you take half your Social Security benefit, add everything else in. And with a couple, it's a little differently. If you can stay below that $32,000, meaning half your Social Security benefit and everything else, wages, IRAs, none of your Social Security will be taxed. The interval is between 32 and 44,000. In that interval there, half of it will be included in taxable income. If you have that half your Social Security and everything else exceeds 44,000, then a good chance 85% of your benefit is going to be included as taxable income. This is a very hard one to deal with, to work around, particularly if you haven't done any pre-planning. We're going to get into what some of that pre-planning might be at the end of the program, so stay tuned. But you can start to do things today in anticipation of trying to minimize the tax hit potentially on your Social Security benefit. And we can talk a little bit how to do it. There are things you can do that'll help you. But ultimately, the tax man always gets a little bit. It's just a question of how much we want to give them over and above that little bit.
Well, again, to plan proactively for that, to minimize that amount, pick up the phone, give Ron Courser and Associates a call. They're happy to help you, to walk you through it, to spot and identify these stealth taxes that can surprise and derail us in our financial progress. You don't want to be surprised. You want to have a plan for how to deal with them. Pick up the phone, give a call, 616-301-2581. 616-301-2581 is the number to call, 616-301-2581. Or you can go online, roncourser.com. roncourser.com. Lots of great resources available on the website as well. And Ron Courser, just a note here. When you say the 50%, the 80% threshold, that's not how much of our Social Security they're going to take. That is the amount that is going to go into the equation for taxable income. Important distinction there, right?
It's true, yeah, because I've seen some things where they say, well, your Social Security is going to be taxed at 50%. That's not true, Lady Jill. They just say they take 50% of your benefit or 85% of your benefit and include it in taxable income. That's all they're saying. And you'll pay it, whatever your real tax rate is, that's ultimately what you'll pay for that benefit.
Now, here is another one, Ron, that a lot of people don't really realize until they're hit with it is the means testing, essentially means testing that is done for your Medicare premiums.
This makes people's heads explode, and I understand it. Let's think back here a little bit. Part Medicare, what is it? It's a great healthcare benefit for people who are 65 and over. It has a couple parts to it that have letters on it. Part A, you automatically get, and people just look at Part A and the Medicare benefit as the buildings, the hospital, the doctor's office, those kinds of things. Part B deals with physicians and things like that, people stuff. Now, Part A you get automatically, and supposedly there's no cost for it. You got to understand that's the government telling you, but let's just play along with them for a minute. There's no direct charge that we can find on that. Part B, however, does have a direct charge. You will pay for Part B, the Medicare Part B premium, and if you're over 65 and you're taking Social Security, that will be deducted every month from your Social Security payment. So right now, for example, the monthly premiums on Part B begin at about $148.50. And depending on income, it can go up even farther. And that 148 is just for a single person that has $88,000 of taxable income, or a married couple of 176. But these premiums, depending on income, can go as high right now as $504.90 a month. That comes out of your Social Security benefit. Now, how do you deal with that? Well, I'm getting Medicare, Ron, and I guess I just got to pay it. That can be true. But before you become 65, it'd be great if you'd let us help you figure out how you might reposition some of your assets, some of your income, to minimize what happens on that Part B, and also would go to the Part D part, because you end up paying for that too. So what do I mean by that? How do they figure out what the Part B payment's going to be? They go back 2 years and take a look at your taxable income. So if you're going to take Medicare at 65, you're retired, whatever, your Part B premium will be based on what your income was 2 years ago when you were 63. And it's always a 2-year lag. So one of the planning possibilities is, for example, if somebody knows they're going to retire in a couple of years and they're going to get a big payout, maybe you can postpone that payout or spread it over a couple of years before taking that income, so that you kind of do the best you can to stay under those thresholds, particularly the $176,000 for a couple. That can be easily exceeded when somebody's been working in corporate America and has deferred comp and things like that. But you can do some pre-planning to try to minimize this. Now, if somebody's blessed with enough income and wealth, it may not be possible to do that. But if you know there's a 2-year look back to determine what the price is you're going to pay for your health care, doesn't it make sense to figure out now, when you're 60 or 63 or 62, what you might do to minimize that? So we can help with that. The other part of Medicare, it comes with the Part D, the drug part. That's a totally different payment. And that one is an interesting one because it's not so much based on your income as it is, tell me what you kind of meds you take and what's going on in your life. One of the things that my wife Nancy does, and in our firm, we combine investment planning, retirement planning, income planning with the healthcare part, and she does that, is we can help look for the most effective, efficient plan you have available. And these things change every year. They can lowball prices, or you may end up getting a different prescription this year that you didn't have last year. That has to be included in the plan. And sometimes they can just go out of whack year to year. So that's an important service we can help. So those of you who are getting close to retirement age when it comes to Medicare, give my wife a call at 616-301-2581, Nancy Corser. She's a knockdown, flat-out expert in this, and she can give you all the information you need to make a great decision on what Medicare plan to use and Part D and what's in your best interest. So give a call, 616-301-2581, and my wife and her staff will be more than happy to help you.
At Ron Corser and Associates, looking after both the health and the wealth. Ron Corser, wife Nancy Corser, here as resources for you, Grand Rapids, and especially if you are going to be turning 65 within the next year, certainly worth the call to make sure that you are getting everything you're entitled to, collecting the right benefits, and signing up for the right plan. Pick up the phone, give a call, 616-301-2581. Now, Ron, it strikes me, although you're talking about stealth taxes here, it sounds as though these were designed very intentionally. And it really hits us with kind of a triple whammy because, one, we have been told to save our money in these tax deferred accounts. So we get to retirement and we've got $1 million. Wait, hold on. No, you don't. That hasn't been taxed yet. And then that causes our Social Security to become taxable. And then that causes our Medicare to raise in premium rates. It's really a compounding effect that leaves us with a whole lot less money than we thought.
It is stealthy, but it isn't stealth. I mean, it's there kind of in black and white. What I tell people I'll have people when we start to go through this, they come to the same conclusion. What's going on here? I'm getting hit 3 different ways for it. And I just said, well, it has to do with the 11th commandment. And they say, okay, what's that? And the 11th commandment is, thou shalt not let thyself be buffaloed. The government doesn't give us anything without first taking money from us. So it's our job as rational human beings to minimize what we have to legally give forth to Caesar or the government. And the more we know, the better decisions we can make going forward. There's, a lot of times we hear this talk about as a loophole. There are no loopholes in the tax code. There are just things that have been put in there for individuals, corporations, people, whatever, to use to their advantage. There's no such thing. The loophole sounds like, wow, Peter, you got this and nobody else didn't. That simply isn't true. No, it is true that Jeff Bezos probably has some advantages that you and I don't, but he's got more money than anybody else on earth. But the tax code is there for everybody. The problem comes sometimes is that we work with people who don't understand some of the basics of the tax code or try to help people from an investment strategy point of view create the most tax efficient investment strategy they can. And that's what we can help people do. So give us a call at 616-301-2581. Be more than happy to help you with this.
Again, 616-301-2581. In fact, you can get that plan in your hands, your course to retirement plan, simple, easy to understand language, actionable, executable items in a timeline for how to achieve your goals. And Ron always takes a proactive look and perspective on the question of tax planning to help you keep as much of your money as possible where required, bringing in experts in that field to make sure that you are getting the guidance that you need to keep as much of your money. Again, give a call to get that plan in your hands, 616-301-2581, 616-301-2581. And we'll come back. We'll talk about a few more stealth taxes that you don't want to be surprised by here on your course to retirement in just a moment. And we're back here on your course to retirement. Grand Rapids Certified Financial Planner, CFP Ron Courser, with us as our resource for guidance and perspective, and helping us today to identify some stealth taxes, things that can derail us into and throughout retirement that we don't want to be caught unaware of. We don't want to be caught by a surprise because these can be costly. So far, we've gone over the end of the stretch IRA, and now the requirement that those IRAs are liquidated within 10 years when they pass on to beneficiaries. Ron and his team doing some very, very specific proactive planning around that. We've gone over how your Social Security may and will likely be taxable income to you, and maybe how you can control that a little bit. We've also gone over the increased Medicare premiums through IRMA, income related monthly adjustment. Basically means testing your Medicare premiums and how much you'll pay for them based on your income. Ron, these can all hit us and kind of a domino effect, leave us with a lot lighter bag of money than we thought we were going to have.
And that's actually what they end up doing without proper planning, without knowing what the rules. So many times we make decisions because somebody didn't give us all the information that was required. And what we try to do as a firm, and we talk to people, is to give them the critical facts, to get rid of all the fluff and the garbage and all that, and just come down with a set of critical facts so they have everything in front of them to make really good decisions. Because I think people can make really good decisions when they have all the right and correct facts. And that's what we try to do. And so the more facts you have, the more clarity you have, the better the decisions you make. And just on those three, and we have a couple more to deal with here that also require a little clarity, so to speak.
Absolutely. So let's continue on our journey. But first, I do want to remind you, ladies and gentlemen, if you've got questions about these, if tax planning seems like an important topic to you, if you want to be proactive and intentional in your plans to keep as much of your money as possible, pick up the phone and give Ron Corser a call now, 616-301-2581. I feel like this is going to be a topic on many of our minds through the coming years, and Ron Corser has been promoting this message of being proactive. He has been here to help savers and investors keep more of their money for 4 years and will be into the future at Ron Corser and Associates, helping more people save more of their money, planning proactively, keeping those dollars, as many of them as possible. 616-301-2581, the number to call. Ron, number 4 on your list, net investment income tax. What's stealthy about this one? What do we need to watch out for here?
Well, this one's gone under the radar for a lot of tax preparers and for actually a lot of people too, because it was introduced in 2013. And what it is, it's a surtax that's paid by high income taxpayers that have significant investment income. What does that all mean? Single taxpayers with investment income and a modified adjusted gross income greater than 200,000. I know somebody's out there saying, well, I don't make that much. And then, okay, I understand that, but there are people out there to do. So as a single person, if this number is more than 200,000 or married and filing jointly at 250,000, some of your gains are subject to a surtax of up to 3.8% on net investment income. What does that include? If you have this modified adjusted gross income above these numbers, it includes capital gains, interest, dividends, rental income, royalties, and non-qualified annuity income. Those are the things that can be taxed an additional 3.8%. And sometimes that can be significant for some people, particularly business owners. So it's one of those situations, if you have that kind of potentially taxable income, if you know you have it and you know there's this tax out there, doesn't it make good sense to sit down with somebody like us and say, how do we figure this out? How do we minimize it? You know, I have some really great investments, rental income, things like that. It's already tax deferred in a lot of ways and tax advantage, but I'm still getting hit with this. What can we do? How can we manage this? We can help you come up with some solutions. Not every problem can be solved. Please don't misunderstand me. But we can help you come up with strategies and solutions to minimize this tax. Because the more you end up earning and the more you end up paying, doesn't it make sense to try to minimize legally what you have to pay? And we can help with that. You know, if you think about the net investment income tax, it effectively increases the 15 and 20% long-term capital gains by another 3.8%. For some people, that can be really significant. So that's another stealth investment income tax idea that came up in 2013. We can help at least talk about it to clear away the confusion about this and how to address it. And then we have those people who are interested in this, give us a call, 616-301-2581. Here's one that drives, the next one is number 5. This drives people crazy. What is it? It's the widow or widower's income tax penalty. It's probably the stealthiest of all the stealth taxes. So what does it all mean? Well, it's kind of interesting if we think about it. The life expectancy of everybody ultimately goes to 0. That means when you're planning as a couple, one of the things that we have to bring up, I don't do it to be morbid or something, is what we call survivorship income. That topic is really important. What does it mean? It means that when one spouse dies, all of a sudden things change. What changes? Well, you lose the Social Security benefit. That's income. But the other thing that happens, which is really interesting and we don't think about it, is that all of a sudden, when you start filing as a single person as opposed to a married couple, the tax brackets and tax situations you run into change, and they can change really dramatically. I always tell people when we have a client that dies and we have to go through this, I just say in a very nice way, You know, the government seems to think that they want to take care of single people and widows. I guess you can believe that, but when you see what actually happens, it maybe isn't exactly accurate to hold on to that statement.
Yeah, in the tax code, it does not seem to hold water, that statement.
No, it's not pleasant for single people. So going forward, you really have to figure out, look, one person does not live on half of what a couple does. That doesn't happen anymore. So certain things are not going to change. You may still have pension income, Social Security income, investment income coming in, but all of a sudden, as a single person, you have fewer opportunities to itemize deductions if that's still a possibility for you, and you have a lower standard deduction and threshold. You're automatically going to be in a higher bracket, almost without saying. You're automatically going to be in a higher bracket. So this requires some planning. It's best done while both the husband and wife are still alive, to position assets, to create strategies that will minimize ultimately what happens when one dies. It's not the most wonderful thing to talk about, but it's very important. I can't tell you the number of times I've met new people and their spouses recently died. And when we go through the income planning and the tax issues, they're really shocked. They're just, sometimes they just can't believe it. And I said, this is the way the tax code is, but we can help. We can help create strategies that'll minimize the ultimate impact of being single. We can help you maybe reposition where some of the assets were so that you have more of a tax advantage way to generate income. There are things that can be done. We just have to do it. So one of the things you have to understand is that the tax code changes for single people from couples. Really important to understand that. The second thing is one person cannot live half as cheaply as two people. That simply isn't going to, there's too many fixed costs in our life, from taxes, sales taxes, gas taxes, real estate taxes, all of that stuff. There's some things that never change. So give us a call. If that's happened to you and you would like to talk to somebody that'll help kind of clear through the clutter of all of this and help you with some really good informed decisions because we provide the needed information, give a call to Ron Corson Associates, 616-301-2581, 616-301-2581.
Or Ron, last week on the program, we talked about protecting our spouse. Now, armed with this knowledge, I feel like even better than if it's happened to you, if you care about your spouse and want to plan proactively to help them avoid this, the best time to be armed with this information and to plan to avoid some of these negative consequences is probably as we are making that transition into retirement, not after we have lost a spouse.
That's very true. That's very true. And that's why thinking about the future, sometimes we don't like to do it, particularly when it's uncomfortable things like this to talk about, but it's something that we have to do. And we try to be as gentle as possible with people. I do understand that. I've experienced some losses in my life too, but we're good at what we do by providing the information somebody needs to minimize legally what they pay in tax, to keep as much as they can of their hard-earned money, their life savings, and to make sure ultimately that it passes on, if that's important, in the most tax advantaged manner to whomever in their family they want to leave it to, or whatever charities.
Well, again, if you would like to talk with a professional, qualified, experienced, certified financial planner, give Ron Corser and Ron Corser and Associates a call, 616-301-2581, 616-301-2581, 616-301-2581, or go online, roncorser.com. That's roncorser.com. All right, rounding home here, Ron, we've had our discussion on 6 stealth taxes. We've covered 5. Number 6.
Well, this is an interesting one, and this one really impacts people living in high tax states in this country, California, New York, and some people even live in Michigan, and that's the $10,000 limitation on personal income tax deductions. This was put into the Tax Act back in 2018, and what it did is it used to be we could write off state taxes and local taxes. You can still do that, but there's a limit now of 10,000. And that was focused primarily on the ultra wealthy who lived in high tax states. And some people say they did it on purpose, But the other issue is that without this, if you think about this, we always hear people say, well, they're taking advantage of the poor and all that stuff. I'm not going to go into the politics. But if we allow the ultra Jeff Bezos of the world to deduct state taxes, that just means the state has to increase taxes on everybody to make up for that. But it's a deduction that has kind of impacted some people in the wealthier brackets. It's something they have to be reminded of. And I'll tell you, one of the ways people are dealing with it now is they're leaving these high state tax states. There's a giant exodus out of California, New York, and Illinois, because those are three of the highest tax states around. New Jersey and Connecticut aren't far behind. So one of the ways that people can always deal with taxes is with their feet. And that's why a lot of people are moving into Texas and Florida, I guess. So we'll see how that all works out. But that's a deduction. It may go away. There's been some talk with this new administration that they may reverse that. We'll just have to see. If I was a betting man, I'd say it's about a 55, 60% chance that this will be reversed simply because of who's there. But we'll see. But it's a tax that really impacts the higher income wage earner. And it's one that you have to be aware of.
Well, again, all of these, I think, are at least items to be aware of and how the tax code works. Now, we've talked about some stealth taxes. These are things that are going to limit your ability to take certain deductions in this case, or that will directly take some of your income if you pass certain benchmarks and thresholds. In the case of the Medicare and the Social Security, and then maybe potentially increase the amount of taxes that are taken out of your legacy if you pass along those tax deferred accounts. In the case of number one, the 10-year limit on passing assets through the Secure Act. So all of these, Ron, examples that we need to be aware of, places in planning that as people are thinking about taxes this time of year, but particularly thinking about taxes because of the political environment that we are in, proactive planning is appropriate, is necessary, is something we absolutely should be doing. Pick up the phone, give Ron Corser and Associates a call, 616-301-2581, 616-301-2581, because here's the good news, Ron. The light at the end of the tunnel is that the 70,000 plus pages of tax code are not all about how to get as much of our money as possible. There are some parts of that tax code that give us some inherent advantages and some ways to pay less in taxes. And we've got a few great ones available to us right now.
We do. And it's not a loophole. I want to encourage people just kind of to deep six that word. Everything in the tax code is there for everybody to use. You just have to either have the income or have somebody help you use it to pay the least amount legally in tax that you can. So where's the good news in all of this? Is there any good news in it? Lord, I hope there's good news here. And one of the things that we've talked about is these other 6 strategies, but certainly the first 5. There's one strategy that can reduce the income tax liability attributed to all of them. And that's a strategy we've talked about a lot this year, last year, and the year before. And that's a Roth IRA conversion strategy. And people are going to go, oh my goodness, we talked about it, I didn't want to do it. Let's just sit back and say, what are we trying to accomplish? You're approaching retirement. You know, and you plan and you hope that God lets you live for 25 or 30 years. You want to make sure you have enough money to maintain your lifestyle and have enough income in retirement to do that. If that's all true, doesn't it make sense to figure out now what's the best thing out there, or the best kinds of combination of strategies we can start to use, which will give us the best chance of success down the road? Meaning we'll have the income we need in retirement to hold on to our lifestyle. We'll have the income in retirement to take care of my wife if I die. We'll have the income in retirement to take care of a grandchild with special needs. We'll have the income in retirement to do those things that are important to us and our family. And one of the great ones to take a look at is creating a multi-year Roth IRA conversion strategy. What does that mean? In the simplest terms, just about everybody has tax deferred accounts somewhere, either through 401ks, IRAs, wherever possible. And it's possible with 401k and IRAs to create Roth money, is to take a look at the different options to do that. to create as much tax-free Roth money today that you can use over the remaining part of your lifetime. Yes, the downside is you will pay more in tax today. But ladies and gentlemen, do you really believe that taxes are going to stay this low for the next 10 or 15 or 20 years? That's a tough one for me to grasp. It really is. I mean, even the current administration has told us flat out they're going to raise our taxes. And I know they're saying it's only going to be to those making 400,000 or more, but ladies and gentlemen, taxes always come down to the middle class because that's where the big money is. So one of the great strategies we can use that attack the first 5 things that we've talked about is to create a multi-year Roth IRA conversion. People say, well, when shall I do that? Today. Well, I'm already retired. Well, how long do you think you're going to live? Another 15, 20 years? Yeah, it's possible. Well, what's the difference if you're going to live 15 or 20 years when you're 70 or 15 or 20 years when you're 50? There is no difference. You're going to live a long time and you're going to pay a lot in tax. So one of the things we can help you do is figure out a strategy over a period of time, as fast as possible, but rationally as possible, to convert as much of your tax-deferred IRA or 401k money to Roth money, from money that's going to be taxed forever to money that's never going to be taxed after the first time. And sometimes people will say, well, they're going to change the rules on taxes. No, they're not going to come back and say, I know you pay tax on your Roth money now, we're going to tax you again. They're not going to do that. I think what may be more likely is they'll say, you know what, effective next January 1st, no more Roth accounts. You can't have them anymore. But those of you who have them can keep using them. Yeah. Why would they do that? Because they're eliminating a tax-free account down the road and they can continue to tax the money.
They get that money back in taxable circulation.
Yeah, it just makes sense. So when you do a Roth conversion or a series of them using a good planning, and that's why you get a hold of a good CPA or tax person to help you with it. We can do it also. But I generally like to involve the tax person to help with this, is to figure out over a period of time, shortest number of years as possible, we convert as much as possible. Now, think about this. The RMDs don't happen anymore, the required minimum distributions out of your IRAs until you're 72. So one of the ways to reduce your dependency on taxable income going forward is to take out, let me rephrase this, to use IRA money now while taxes are low to supplement any retirement income you may need, because you know taxes are going to go up. So one of the things that a Roth strategy can do over time, it can reduce the value of your taxable assets. It can reduce the impact of that 10-year rule on inherited IRAs.
Yep.
It can help decrease the Social Security combined income threshold, potentially helping you decrease the amount of Social Security money that can be taxed. That's another benefit. It can decrease the modified adjusted gross income that we talked about dealing with Medicare Part B and Part D. And if you do this strategy early enough, it can have an impact on all of those things. And it's always important. So those are some of the things that a Roth strategy can do. We're good at helping people understand the concept. We're really good at working with your other tax advisor to figure out the most efficient tax manner that we can come up with to give you as much tax-free money, as much income in retirement as possible without having to worry about your lifestyle going down or changes that may come down the road.
Ron, I've even heard the objection, oh, well, the limits are so low on the Roth IRA. Is it really going to make a difference to me at this point? You know, I can only get $6,000 or $7,000 a year. I actually had this conversation within my family, and they didn't end up using all of this, but we talked it through, and I discussed this with them. We figured out that it was possible to get up to $80,000 a year put away in different Roth accounts, because husband and wife have the ability to make a contribution at this point in time for last year and for this year up until we file our taxes. So that was $14,000 a piece. Times 2 is $28,000. Plus, they were not aware that some 401ks offered Roth components to the 401k. So each one of them had $26,000 there that they had the possibility of contributing. Now, you know, that's not going to be for everyone, but don't let that be a prohibitive factor in exploring these as an option, because the benefits, Ron, you just listed about 6 or 7 there, that they are incredible in the amount of money that you actually get to keep over your lifetime. And here's the big one to me, Ron, is that when we put away money for retirement and we don't pay taxes on that money at that point in time, we are doing that under an assumption that taxes are going to be lower into the future, or that is somehow providing us some advantage. Well, if taxes go higher, then we have less money than we thought. Whereas if we utilize these Roth accounts and taxes go higher, then we end up having more money than we thought. And if they go either way, we are going to be in a better situation than we anticipated and planned by using those tax-free accounts with Roth. If we're wrong with our assumption or we're correct, we're spot on for where we thought we would be, or we're in a better situation than we thought we would be.
One of the things that's hard, I think, sometimes for people to grab onto is that, well, I've heard this from some tax people. Well, we don't know the future. We'll just wait and see what happens. My response to that is, I don't know the future. But we have a new administration that's already said they're going to raise taxes. We have a government that's been printing money. 2 of the printing presses blew up and burned out because they were printing so much money. They got to replace the presses. We have more of that going on. I really think it's not exactly a strong thought or accurate to say, I'll just take my chances because I think taxes may be the same or lower.
Well, very contrary to your position and your profession, Ron, would be to, well, I don't know what the future holds, so I won't plan for it. It's not really an attitude that gets us a lot of progress or gets us where we want to be.
Well, I'm reminded of that Geico, or not Geico, Liberty, with that ostrich, and it puts his head in here. And it's anyhow. I digress for a moment. So let's think.
That side's still exposed, right?
Yeah. Let's take a look at this and talk it through a little more. There's a lot of ways to save tax-free. Sometimes people get confused between the difference between a Roth conversion and a Roth deposit. Those are 2 different creatures. A Roth deposit means every year, if you're over 50, you and your spouse can put in $7,000 each into Roth IRA accounts, even if only one spouse has generated all the income. As long as you have $14,000 of income, you can put $14,000 into the Roth, $7,000 each. If you're under 50, it's $6,000 each. That sometimes is the easiest way to approach saving on a tax-free basis down the road. The second way to deal with Roth is what we call the Roth conversion, where we take money from our IRA, we pay the tax on a portion of it, and we move it into a Roth IRA account. All of a sudden now we've taken money that's going to be taxed forever, because you leave money in an IRA, they're going to tax it every single year, either because you take money out because you need income or with the requirement of distribution. So you're going to take money that's going to be taxed forever, and you're going to move it into an account that's only going to be taxed just one time. It's going to be in a Roth IRA, and it's never going to be taxed again. And as long as you pay attention to some of the rules there, it's easy to access that money when you need it. So there's opportunities for everybody, whether you're 22 years old and starting out in the world with a brand new job, or you're 72 years old and wondering what you're going to do with all your money because the government seems to want more of it than you can give to your family. We can help you with this Roth idea. Give us a call. We can have just a discussion only on the Roths, and it'll be a discussion that'll be well worth your time, I promise you. Call us at 616-301-2581, 616-301-2581, and we will do the very best we can to give you the information you need to make an informed and great decision on Roth accounts.
616-301-2581, the number to call, 616-301-2581. And we didn't have time to get into it today, but there are specific strategies, there are specific tools and products that can help you implement these strategies more efficiently and effectively, leverage your money, keep more of it. You want to find out about these now rather than later. If you have a tax-deferred dollar in a retirement account, you owe it to yourself to figure these out, especially if you have a large balance in those tax-deferred accounts. These strategies can make a remarkable difference in your future and in the legacy that you'll leave behind. Let's find out about these sooner rather than later. Give Ron Corser, Certified Financial Planner, a call, 616-301-2581. We always appreciate your time, Ron, and being our guide here on your course to retirement.
Well, that's been fun. I get a little passionate talking about this, but Ben Franklin said, what, a penny earned is a penny saved, or a penny saved is a penny earned, something like that. And it's the same in taxes. For every dollar you can reduce your tax burden today, that's an extra dollar you've earned going forward. So give us a call, 616-301-2581. Go to our website, www.roncorser.com. Be more than happy to answer your questions or to help you. Give us a call. We're waiting. I really am passionate about this because I see that train coming down the track, as a famous country and western singer once said. And I don't think it's going to stop for me or anybody else. So the more we can do to deal with the tax issue now, the better off we're going to be down the road. So thank you, everybody, for listening. Look forward to hearing and talking with you again next week.
Tune in to Ron Corser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncorser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Advisory services offered through Brookstone Capital Management, a registered investment advisor.